Howdy, everybody. Welcome to Liberty Call. Today is Monday, May 13th, 2024. Hope you're having a fantastical day out there. Pretty nice day here in Colorado. It looks like we got some clouds coming over the Front Range right now, which is going to make it a little gloomy, but it's been a beautiful day so far. So anyways, hope you had a good weekend. Astros took 2 of 3 from Detroit, which was, they played like crap on Saturday, but the other 2 days, they didn't look too bad. So, hey, we'll take the wins where we can get them. All righty. Well, if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All right. Looks like the markets were in a gloomy mood today. Let's go ahead and jump over to the indexes and see how they did today. Dow Jones was down 0.21%, 81 points, closed at 39,431. The S&P 500 flat, down 0.02%, closed at 5221. NASDAQ was up 0.29%, closed at 16,388. The VIX was up 8.37% today. It's at 1360 right now. Canada down 0.22%, Brazil up 0.44%, and Mexico flat up 0.02%. Over in Europe, Germany was down 0.18%, the UK down 0.22%, France down 0.12%, the Netherlands up 0.14%, Spain up 0.42%, Italy up 0.46%, Switzerland down 0.07%, and Portugal down 0.58%. Russian exchanges both green today, the MOEX up 0.26%, the RTSI up 1.24%. And the Asian markets, starting out with the Nikkei, it was down 0.24%. Australia up 0.01%. New Zealand down 1.19%. In China, the Shanghai was down 0.21%. The Shenzhen component down 0.6%. China 50 down 0.42%. DJ Shanghai down 0.1%. Hang Seng up 0.8%. And the Taiwan weighted closed last on the 9th. And it was down 0.68%. All right. So those are the markets for today. Feel good about them? I don't. All right. Let's go ahead and move over to the weekly economic update. Stocks notched a solid gain last week as rate cut expectations paced the rally as Q1 earnings season wound down. Monday opened with stocks picking up where they left off the prior Fridays. Stocks were still basking in the afterglow of fresh jobs data, which eased investor concerns over an overheating economy. That and reports of a possible Middle East ceasefire fueled Monday's rally. Stocks hung out in a narrow trading band on Tuesday and Wednesday, yawning at the sparse economic news and a handful of negative earnings results. By contrast, the NASDAQ edged lower over those 2 days. On Thursday, the S&P 500 closed above 5,200 for the first time since early April. The next day, stocks rallied and the Dow clinched its 8th consecutive day of gains, the longest winning streak since December and its best weekly performance this year. Fresh data showed consumers continue to have inflation concerns for the year ahead, which was unsettling. All right. Jobs data from the past few months has shown unemployment levels remain low while job growth stays strong, but not too hot. And last week's Conference Board's Employment Trends Index for April projected slower job growth in the second half. The markets all year have responded well when the Goldilocks outlook suggests that the economic indicators are just right. All right. Economic data coming out this week. Monday, we have the Fed official Loretta Meester speech. Loretta is very entertaining. Tuesday, we have the Producer Price Index and the NFIB Small Business Optimism Index. Wednesday, the Consumer Price Index, retail sales, business inventories, and a Fed official Neil Kashkari speech. Thursday is housing starts, jobless claims, industrial production, import and export prices, Fed officials' speeches from Patrick Harker and Raphael Bostic, and Friday is the leading indicators. Just a few companies reporting earnings this week. Tuesday is Home Depot, Wednesday is Cisco, and Thursday is Walmart, Applied Materials, and John Deere. And that is the weekly economic update. I know I feel smarter. How about you out there? Anyone? All right, let's get to the market recap. S&P 500 flat ahead of key inflation data. The S&P 500 showed little movement on Monday as investors anticipated upcoming inflation data that could influence the Federal Reserve's monetary policy stance. After 3 consecutive weeks of gains, Wall Street remained cautiously optimistic, driven by strong earnings reports and the possibility of future interest rate cuts. Yeah, keep hope alive, folks. Investor focus is squarely on key inflation reports scheduled for later this week, including the Producer Price Index and the Consumer Price Index on Tuesday and Wednesday, respectively. The market is reacting to previous hotter than expected inflation data from Q1, which led investors to adjust rate cut expectations downward, with only 2 cuts anticipated this year, if they're lucky, in my opinion. Amidst the anticipation, Federal Reserve Vice Chair Philip Jefferson emphasized the need to maintain current interest rate levels until clear signs emerge that inflation is moving substantially towards the Fed's 2% target. In the tech sector, ARM Holdings surged 7% following its announcement of plans to develop artificial intelligence chips projected for mass production in autumn of 2025. This news contributed to the company's positive market performance. Meanwhile, Intel saw a 2% rise after reports of advanced talks with Apollo Global Management regarding an $11 billion chip manufacturing plant in Ireland. Additionally, Tesla gained 2% amid news that President Joe Biden could announce new tariffs on Chinese products targeting sectors like electric vehicles. And I believe the tariff, if I could pause here, was going to be 100% tariff on all electric vehicles coming from China. So I don't know what that's going to do. Or is that going to start some sort of a trade war? Who knows? In pre-market trading, GameStop surged over 74%, driven by enthusiasm among the meme stock traders following a notable post by Roaring Kitty. Okay. NVIDIA maintained stability despite a price target increase from Jefferies to $1,200 per share, citing the company as their favored AI chip stock. All right. So that's everything in the markets for today. Let's go a little deeper. A recession could trigger a U.S. debt crisis, Wall Street economists are warning. So a lot of articles these days are about recession and crises. So maybe the people in the financial journalism are actually starting to pick up the scent that things aren't as good as they say they are. All right. As Congress contemplates extending the 2017 Trump tax cuts, concerns over sustainability of U.S. fiscal position are intensifying. Projections indicate that the federal debt to GDP ratio will hit 116% by 2034. Actually, I think it's like at 130% right now, surpassing levels seen during World War II, and could climb to 172% by 2054, as reported by the Congressional Budget Office. That also assumes that the gross domestic product of the United States continues to grow at the same pace, which, if, the financial or the federal government falls apart, a lot of that spending disappears, because a lot of it is military and government spending. So we'll see. All right. Economists from Wall Street, including Torsten Slock of Apollo Global Management and Michael Ferroli of JP Morgan, highlighted the potential challenges associated with increasing Treasury bond issuance needed to finance government operations. They raised questions about whether markets can absorb the new debt issuance, especially given the limited capacity of large banks to hold government debt on their balance sheets under post-financial crisis regulations. Ferroli emphasized the risk posed by potential economic recession, which could exacerbate deficits and debt levels, potentially triggering a U.S. Debt crisis that could reverberate across the global financial markets. He pointed to concerns about the ability of Treasury markets infrastructure to handle increased debt issuance during a recession without encountering problems similar to those witnessed in other markets. Sloak also highlighted the evolving landscape in the Treasury bond purchasers, noting a shift from foreign governments like China to domestic pension and insurance companies. The shift from yield insensitive to yield sensitive buyers could increase vulnerability, particularly if the Federal Reserve were to cut interest rates during a recession, leading to a decline in demand for U.S. Treasuries. In summary, the growing debt levels and deficits, coupled with changes in composition of Treasury bond purchasers, are raising concerns among economists about the potential for a debt crisis in the U.S., particularly in the event of an economic shock like a recession. This situation underscores the need for careful fiscal management and consideration of long-term economic stability. I don't think any of the people in Washington give two craps about any of that. They just want to keep their jobs and keep the money flowing to the people that they're laundering this cash through. So All right. One last article here from our friends over at First Trust, Mr. Brian Westbury. And this week's article is titled, Would Trump Reignite Inflation if he's reelected? We shall see. All right. Brian Westbury, in his analysis, challenges the prevailing theory that inflation would surge if President Trump were reelected. Westbury argues that while Trump's policies such as tariff increases and reduced immigration could influence certain sectors, the overall impact on inflation is likely to be minimal without corresponding monetary policy adjustments. Westbury highlights historical examples, noting that despite Trump's tariffs during his first term, inflation remained subdued until the Federal Reserve's actions during the COVID pandemic. Actually, let me stop there. That's not totally true. The Fed started raising rates in 2019, and the economy started to get very wobbly. The yield curve inverted in the fall of 2019, which led me to believe that we were heading into a recession in 2020. Who knew that we were going to have this fake cold come along and give the government an excuse to pour all this money into the economy and think that nothing is wrong? So we shall see. Where was I? He also questions the assumption that slower immigration under Trump correlated with lower inflation, pointing out that inflation has surged under President Biden despite increased immigration. Well, we should deport every illegal in America. I'd love to do it. Personally, I'd kick doors in myself. The crux of Westbury's argument lies in the role of monetary policy as a primary driver of inflation. He downplays the potential impact of political appointments to the Federal Reserve, suggesting that nominees and policymakers would be wary of being associated with inflationary policies. Westbury speculates that even under a potential Trump reelection, Fed appointees like Kevin Warsh and Kevin Hassett would prioritize stable economic conditions over overly accommodated policies. Westbury acknowledges that inflation may indeed be a concern in the years ahead, projecting an annual rate of around 3%, irrespective of election outcomes. He emphasizes the need for the Fed under any leadership to address and rectify inflationary policies implemented since the 2008 financial crisis. Basically, keeping interest rates at zero for more than a decade was a bad thing. And then dropping rates back down to zero with COVID and then printing all that money just multiplied the problem. In summary, Westbury argues that while certain policy changes may have sector-specific effects, the broader trajectory of inflation is primarily shaped by monetary policy. He underscores the importance of a balanced approach to economic policy making to mitigate inflationary risks, regardless of the political landscape. All right, so good stuff. All right, well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. And if you happen to still be watching at this point, please give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All right, well, hope everyone has a wonderful evening, and I shall talk to you again next time. Adios.